Hello, everybody. So I don't have microphone. I can't talk loud. It's very sad for me. But we're on the ISLM model. Before we do that, I have a couple organizational things to say. First of all, I am finally getting onto the videos. I know I'm a bit behind in videos. I did week 9 yesterday. By the end of the weekend, I'm hoping to be totally caught up in videos and keep you current. I know you guys are the guys who are here, so it's not as big a deal for you as it is to some, but there will be videos. The other thing to say is there's a screw up with the tutorials. In particular, no tutorials were scheduled for next week. I've talked to people, there's no way to fix it now, which means, generally speaking, there will be no tutorials next week, which means those of you who have scheduled tutorials for next week, you can email your homework into the tutors, and the address is econ200020@ucd.ie. I'll send that email around, so with this and all. But you email your homework there, you'll get it done. The one exception to that is people on Friday of next week. People on Friday of next week can email their things in too. But people on Friday of next week, those people got, they couldn't go on Good Friday. Now they can't go again. It's too much. It's too much for one group of people. So they've arranged a tutorial on Friday for those people, so that they're not missing 2 of the tutorials, which is just bad, right? So if you have a tutorial on Friday of next week, you can go. If you really, really, really want a tutorial, you show up at the Friday tutorial, it'll be okay. We don't have to be tough on this anymore. It's the end of days, and so if there's room and we can let you in without the fire marshal getting on our case, no problem. But for any of you next week, you can email your homeworks in and get full credit for them. Okay. Other things I want to say, your exams will hopefully be back by Monday. I've been told I'll get the exams back today, and then I'll tabulate them, get back on Monday. If they don't have them today, they'll have them on Monday. So early next week, you should have your exam scores. Okay. Questions about all this sort of stuff? Okay. So what are we doing? We're doing the ISLM model, which is sort of our quick and dirty way of thinking about the economy, putting the financial market and the goods market together. We have looked at the IS curve, so we'll go through that stuff. We derived the IS curve, and we did shifts in the IS curve. And now we're going to talk about the LM curve. So it's going to be the same sort of thing, but now we're going to be talking about the financial markets. In particular, we're going to be talking about the money market. It's going to be our simplified version of the financial markets. Obviously, we could make this better, more complicated, more interesting, but here we're just going to have a very simple model of the financial markets, which is just people's demand for money and the amount of money that the central bank supplies to the market. Right. So rather than going through PowerPoints, which I think which you'll have, right, but just to I think it's better to do it on paper to see how it comes. Like when you see it on the screen, it's just, there it is. And it feels like a memorization thing where talking through it helps. But of course, you'll have those as well. Okay. 2. So our ISLM, right, when we did IS curve, we said, we're going to graph this thing. We're going to make our ISLM curve. It's going to be Y and I. So we're going to have this thing, which is coming from the goods market, the amount of stuff produced. And we have this thing coming from the financial market, which is the price of liquidity, the price of money. Holding your wealth in a very liquid asset, you're giving up the interest rate. Right? And so we had those things, and we're using those to bring these 2 markets together. And when we did the IS curve, we said, well, the IS curve is coming from the goods market. And so we want to compare that with Y, which we had from the planned aggregate expenditure thing. Right? And we found our Y is equal to planned aggregate expenditure. and we found our particulars C plus I plus G plus net exports at a particular interest rate. And that gave us our combinations of I and Y that gave us our IS curve. Right? So the goods market was determining Y, so we put the goods market directly above this thing so we could compare the Y that we got out of the goods market with the Y that we're putting in this graph that's going to give us our IS curve. Right? Which way is it? Which way is it? If we lower the interest rate, if interest, I'm drawing it, but if I lower the interest rate, output goes up. It's the other way around. IS curve looks like this, right? You have to derive it each time. You can do this 30 years and not memorize this stuff. You shouldn't memorize this stuff, right? You should derive it each time. It's not hard. You should say, if interest rate goes up, what happens? If the interest rate goes up, there's less investment, which means less goods are being purchased, less goods are produced, right? So if interest rate goes up, we're going to have less goods. So IS is downward sloping. Okay, now we're going to do the same thing for the financial market, for the money market, except the money market isn't determining output directly. It's involved, of course, but it's not directly determining output. It's really determining financial variables, in this case, the interest rate. So rather than putting our money market above like we did before, we're going to put it to the side. So I'm going to have the same Y and I, where I'm going to do my IS. In this case, I'm going to do my LM. But this time, I'm going to put the money market over here to the left because interest rate is the price of money. And what I want to do is I want to trace out all the combinations of interest rate and output that make the money market be in equilibrium. Okay? So that it's in equilibrium. The same thing I did before, right? I've traced out all the combinations of interest rate and output that made the goods market be in equilibrium. That was my IS curve. And I said, for this level of interest rate, what output would be in equilibrium? For a lower interest rate, what output would be in equilibrium? For this interest rate, what output would be in equilibrium? And I just traced those out. Now I'm going to do the same thing, except I'm going to be doing it sort of the other way around. So here we've got the money market. Remember, we have some kind of money demand. And money demand is just, obviously, we all want all the money in the world. That's like a thing. We're greedy in that way. At least our economic people are greedy in that way, right? In economics, we think of people as greedy in that way. But real life, you only have so much wealth. And so this is the decision of how much of your wealth you put into liquid assets, money, and how much instead you put into something that gives you an interest return. And so if you put your wealth into money, it means you're not getting the interest return that you could have. So the interest rate is just the price of holding your wealth in a liquid asset. It's what you're giving up to hold your wealth in a liquid asset, money. It is, therefore, the opportunity cost of holding your wealth in terms of a liquid asset. Therefore, we can just think about it as the price of holding your money. Just what you're giving up. You could do something else with your wealth, but you decided to hold it in this liquid asset, and that's costly to you. How costly? Well, it's whatever you gave up. And you gave up the opportunity to loan it to somebody and make an interest return. So if interest rate is high, you're giving up a lot in order to hold your wealth in a liquid asset, and therefore you don't hold very much of it in a liquid asset. Right? But if the interest rate is low, you're not giving up very much by holding it in money. Right? You're giving up 1%. It's not a big deal. I'll hold a lot more of my wealth in terms of a liquid asset. Right? Because you don't know what comes up. Maybe you want to go to Bermuda. I don't know what you want to do with your weekend. Right? And then maybe you get hit by a truck in a scarier situation. And you need the cash. Right? So just as a precaution, you can keep cash around. If the interest rate is low, it doesn't cost you much. Why not? But if the interest rate is high, say, I'm not likely to get hit by a truck this weekend, and I'm giving up this 20% interest return by holding my wealth in terms of money. Let me not and just risk it, and I'll hold my wealth in terms of other things that pay me an interest return. So the lower the interest rate, the more money we want to hold. The higher the interest rate, the less money we want to hold. Right? Of course, that's how much we want to hold, but how much is there? Well, that's decided by the central bank. just something that central bank can pick totally on a whim. Hopefully, they got some kind of Taylor rule going on in their little brains or something, but they can do it on a whim. They can just pick whichever one they want, right? And so here we have the equilibrium interest rate. Okay. Now, notice to do this, money demand, which is something we drew there, that depends on lots and lots of stuff. It depends on how likely do you think you are to get hit by a truck? How likely are you to go to Bermuda on the weekend? No, it depends on your life. It depends on how much does it cost to go to Bermuda on the weekend. So the price of things, right? If you think about maybe I'm going to buy a pizza, well, if pizza is cheap, you don't have to hold very much wealth in terms of liquid assets to buy a pizza. If pizza is expensive, you have to hold more, right? So it's going to depend on the price level, but importantly for us, it's going to depend on income, right? If you have a lot of income, and this is something you may have noticed in your life, people with a lot of income tend to have more money around than people without a lot of income. I know, shocking. But so if we have lots of income, it means we're probably going to make lots of purchases, and money is the thing that makes purchases easy. So if we have a lot of income, we're likely to hold more money than if we have very little income. Okay? So when we drew this money demand depends partly on income. Also, prices are another one that it depends on. But crucially here, it depends on income. And so what we did when we drew this curve is we said, well, in reality, it depends on all these things. So if we had a really perfect graph in 4 dimensions, we could draw how money demand is affected by the interest rate, income, and prices, right? Then we have money demand on one axis, interest rate on another axis, income on another axis, and some kind of 4th dimensional axis, we'd have prices. And we have the whole map of how all this works. But we can't because we're stuck with our stupid 2-dimensional blackboard, right? And so we can only graph 2 things, even though clearly we want to graph 4. Right? So if any of those other things change, the things that we didn't graph, we're going to shift the curve. Not because anything is really shifting, but because of the limitations of our graph. Right? We've done 2 dimensions. If we forget about prices, we would want, ideally, to have a 3rd dimension coming out here with income on it, and there'd be a whole sort of sloped thing going on, and we just took a slice out of this for one particular income. Okay. So if income changes, this money demand is going to shift. Okay. And so we're going to do the same thing we did before with IS. Right? When we were deriving IS, we said, pick a particular interest rate. What is the equilibrium level of output? The interest rate determined investment, which determined output. Then we tried a different interest rate. We said, for a different interest rate, what happens to output? Investment changes, output changes, and we just graphed all those things together. We're going to do the same thing here, except now interest rate is being determined by this market, and output is really being determined in a larger sense by the goods market. Obviously, they're both intertwined, but goods market is really determining output, and the money market is really determining interest rates. Right? So the goods market is the output is at least sort of a creature of the goods market, even if they're jointly determined. Right? Whereas the interest rate is more of a creature of the financial markets, even if they're jointly determined. So thinking of output as completely outside the control of this market, we're saying if people have a certain level of income, this is the money demand, and that's the interest rate. So we can go over here and say, well, for that level of income, we drew it over here, this is the equilibrium interest rate. And so that is a point where the money market is in equilibrium. Okay? But then we can try something else. We can say, what if we become richer? Could happen. Like, what if income, instead of being that, was this? Yeah, this is for Y1. Well, if we become richer, we move in this direction, right? Something happened in the goods market, we became richer. Now we have more income. As rich people, life is great. As rich people, we do whatever rich people do, which is buy stuff. And money is the thing that makes buying stuff easy. That's its definition, right? Anything that makes buying stuff easy, we called money. And so if we want to buy stuff, we're going to want to hold more money. So at any particular interest rate, let me do this in a different color. At any particular interest rate, we're going to want to hold more money than before. So the whole money demand curve is going to shift to the right. At this interest rate, we want to hold more money than before, and so on. Demand with Y2. With this higher Y, now we want to hold more money than we did before, which gives us a higher equilibrium interest rate. So we just carry that over, and that gives us another point on this LM curve. Okay, so we're doing the same thing. We're saying something is determined largely outside of this market. We're going to try all the possible values of that something. In this case, all the possible values of Y, and we're going to see what interest rate we get in this market for each of those values of Y. And we're just going to trace them out. And we could trace every single one, and we would get something that looks like this. This is our LM curve, which is giving us all the combinations of interest rate and output that are consistent with equilibrium in the money market. Okay? Okay. Yeah?
What's on the x-axis of the left graph?
Ah, that's a very good question. That's a very good question. That's euros, just the number of euros in circulation. Okay? Of course, that's a little bit more complicated because we're counting bank balances as part of that euros in circulation, but it's just the number of euros, some measure of the number of euros in the economy. Yeah. Okay. So, there we are. Questions about this? Okay. Now, importantly, we have come up with all the combinations of Y and I so that the money market is in equilibrium. But of course, lots of other things matter for people's desires to hold money or the amount of money in the economy, right? Lots of other things affect the interest rate, not just Y. So if any of those other things change, this curve is going to shift. Okay. So if Y changes, this curve will stay where it is because it has Y in it. But if anything else that matters changes, the curve is going to shift. And I'm going to do two examples. Suppose the price level goes up. Things become more expensive. Okay. So again, in green, I'll do the initial conditions. We've got euros down here. Thank you very much. And we've got money supply, money demand at Y, Y1, P1. Right? And this is our equilibrium, this is our equilibrium interest rate. And over here, that means we've got some LM curve like that, our initial LM curve. Okay. Okay, so that's our LM curve. And I could, of course, try out all the different Y's and shift it up. But of course, it becomes the top graph and it becomes messy. So I'm just going to follow out this one point rather than trying to trace out the whole thing. Okay? But at this one point, suppose that the price level goes up. Well, if the price level goes up, why are we holding money? We're holding money in order to maybe buy stuff. Right? And now buying stuff is more expensive than it was before. So we're going to have to hold more money than we did before to buy the same stuff. Right? And so overall, for the same level of output, for the same interest rate, we're going to want to hold more money than we did before, just because it costs more to buy stuff and you need money to do it. Right? So what we get is at that same interest rate, now money demand is higher. I'll shift it out. At any particular interest rate, money demand with P2, with the new higher prices. And the whole money demand curve shifts to the right. At any particular interest rate, you would want to hold more money than you did before. Right? So at each level, the whole thing shifts to the right. People with me here? There's some quizzical looks. No one's willing to admit it. Go like this if you're totally lost. No one has to know. No one has to know. Okay, people aren't doing that. I'm gonna continue. All right. So, money demand shifted out, which means at this same level of income that we had before, at this level of income, remember this is Y and this is I, at that same level of income, we now have a new higher interest rate. So at that same level of income, our interest rate is now this. Right? So this whole money demand curve shifts up as the price level goes up. The money demand, this LM curve. Shifting up. Importantly, it doesn't shift back, it doesn't shift to the left, it shifts upward, right? Because that's our story. Our story is output is a creature of the goods market. The money market just takes those outputs as given, right? If you think about some kind of money fund manager or some bond trader or something, they don't think, I can affect the output of the economy. No, they just think, how do I make some cash? Do I want higher interest rates or lower interest rates? And so the interest rate's something that's determined in the money market. They're taking the goods market as given, taking output as given, people's incomes as given. They just do the best they can, right? So because it's a feature of the goods market, we're looking at for any Y, what is the equilibrium level of interest rate? And that might change, but the Y is taken as given, and then we just find out what interest rate matches that. So it shifts up and down. It doesn't shift back and forth, left and right. Just the same way the IS curve shifted left and right, because the interest rate was something that the dumb bond traders were doing, and working people just took the interest rate as given and decided how much to work, right? And so there, we were thinking about the interest rate as a creature of the financial market, and we're deciding on how much to produce. And so the amount that you could produce shifted left and right, but the interest rate was something outside of that market. Okay? In the end, of course, they're all interconnected, but that's how we want to think about it. So here, interest rate is a creature of the financial markets, and so we just shift up and down, okay, taking output as given. Okay. Example 2. Here we're going to have money supply goes up, right? Because the money supply is something that the central bank can just pick. It is a policy variable, something that they have control over. And so we wonder, and you can't read that because it's not on the screen, but money supply goes up. We'll do the same thing. So over here, I've got euros, I've got the interest rate, I've got the money supply, money demand. Over here, I've got Y, I've got the interest rate, and I've got our LM curve. Okay, with money supply 1. Money supply 1 is going to be less than money supply 2. Okay, so at this particular, carry this out. At that particular interest rate, we have this Y, or more importantly, at this Y, we have that level of interest rate, right? That determined the money demand. Now, at that same level of Y, now that money supply has gone up, we want to see what happens. So we're going to keep the same money demand, the same Y, call it Y1. Okay. At that same Y1, we're going to find out what happens to the equilibrium interest rate. So when we increase the money supply, money supply 2, this is money supply 1, it just shifts out to the right because central bank just picks a higher money supply, right? They do open market purchases, buying a bunch of government bonds, printing the money, injecting it into the banking system, whatever, and now there's more money going around in the economy. Right? Open market purchases. Okay. Now we got more money in the economy, which means there's money floating around more than really people want to hold at that interest rate. So the interest rate has to fall so that people are willing to hold that much money. And so the interest rate at that same level of income will fall. So at that same level of income, we get 2, right? This is with money supply 2. The whole LM curve shifted down. Now, I did that for one particular level of income, but I could have done that for each and every level of income. At any particular level of income, the interest rate that clears the money market will go down because there's just more money around, and so the price of money has got to fall. Right? If there's more shoes around, the price of shoes will fall. If there's more milk around, the price of milk will fall. If there's more money around, the price of money will fall. It's just the shifting out of the money supply. Okay? And so the curve shifts down. Okay. These are the two we're going to worry about. In the IS, of course, we're going to worry about changes in government spending and how that shifts the IS. Here we're going to worry about changes in prices and changes in the money supply and how that shifts the shifts the LM. Okay. When you're studying for this, please, please, please study it the way I did it, more or less, in the sense that I am about to take the IS and the LM and put them together. But if you're sort of starting with, your starting point is, let me look at the IS-LM curve with the two crossing and the magic point where they cross, it's very hard to understand what's going on. You want to think about each of these curves as separate entities and see how do they shift, what makes them shift. And once you understand the IS curve on its own and the LM curve on its own, then you can put them together. Okay? But if you start out looking at the graph where they're all together, you will for sure get yourself, well, not for sure, very likely get yourself turned around. And the reason is this is economics, and in the economy, everything's interconnected. Right? I've been pretending like output is a feature of the goods market, and we don't have to worry about it. We take it totally exogenous. But of course, it's all intertwined, right? The goods market is going to affect the money market market's going to affect the goods market. So as you're telling stories, it's really easy to get them discombobulated and intertwined, and right? Because that's natural. The beauty of the models is that they separate things out into easily to understand components and then put them together. Right? It's not that people don't know how to think about the economy. You could think about it, but because you're thinking about everything together, it's very easy to go on sidetracks and to miss major things and to get confused. Right? But the beauty of models is we break it down into various components that we can understand in isolation and then put them together, and then we can have the interconnections between them. They stand out better, and we can logically reason about them, right? And so really, I strongly recommend look at the IS curve, understand the IS curve, understand what makes the IS curve shift. A separate piece of paper, look at the LM curve, understand where the LM curve comes from, understand what makes it shift. And then, and only then, put them together. Okay. Oh, yeah. Old people are always giving advice to the youth. Yeah. So, you do you, but that is my advice to you. Right. Okay, so now we want to put them together. And so we got Y, I. We've got our LM, which we just came up with. And we got our IS, which we came up with last time. This is looking very familiar. We seem to have a line going up. We seem to have a line going down. I'm willing to bet that there's something magic about the point where they cross. And so if I was going to be like a betting man, I would say, this is a magic point. And this is going to be our equilibrium interest rate. And this is going to be, I shouldn't call it star. You call it, what do I call it? I'll just call it Y. That's going to be our equilibrium interest rate, and that's going to be Y. I shouldn't call it Y star because I was about to put Y star because I was about to put Y star, which of course we defined as potential output, which is not what's going on here. It is just equilibrium output, short run equilibrium output. And so now we have a prediction. Why is that our prediction? Well, the IS curve is saying these combinations of interest rate and output give us equilibrium in the goods market. Right? Everything on the IS curve is equilibrium in the goods market. And everything on the LM curve is equilibrium in the money market. And we think that probably both markets are going to be in equilibrium in the same time, right? At least in the long run, at least eventually, right? Or at least tend towards equilibrium, right? Real life is messy, but probably equilibrium is something that there's forces leading us to. Right? And so that would be our prediction for what's going to happen in this economy. That level of output, that level of interest rate. Okay. Which is fine as far as we go. Right? You know, we have a prediction, magic point where they cross, lovely, good for us. But of course, that's not particularly useful, because if we really wanted to know what equilibrium was in the goods market, we would look at the Bureau of Statistics. What are they called here? Anyway, the guys that put out the statistics and say, what is GDP? And they would tell us GDP, and we would say, there's equilibrium for you. And then we'd say, what is the interest rate? We'd look in the Financial Times, we'd see the interest rate and say, there's the interest rate for you. Now we know what equilibrium GDP and interest rate are. We've learned nothing. Yeah, we made some graphs, and that's good for us. But where it becomes useful is now we can start asking what-if questions. What happens if the price level goes up? If there's inflation? What happens if we increase government spending? What happens if we increase the money supply? Right? So in and of itself, nice enough, pretty, line up, line down, magic point where we cross. You know, all the economists have that tattooed on their butts. But what does it get you? Well, it gets you the ability to make predictions. So let's do that. Right? So we can do various thought experiments. We'll do the ones that we did recently. Let's say, suppose money supply goes up. What happens? Right? Well, if money supply goes up, we just said that the LM curve shifts downward. It shifts in a downward direction, like so. Which means we get a new level of output, and we get a new interest rate. So output goes up, interest rate goes down. Beautiful, beautiful. Now we have a prediction, right? We increase the money supply, this is what's going to happen. We're going to have lower interest rates, we're going to have higher output. Good for us. And we can see, like, where is that output coming from? Well, it's actually coming from, we're moving along this IS curve, right? Moving along this IS curve as the interest rate falls, which is saying that as the interest rate falls, investment is going up, and therefore output is going up. Right? This is our connection between the two markets. And this is the beauty of this model, is it's a very simple, I know it looks complicated, but it's very simple as these things go, way of bringing the financial market and the goods market together in one model. Okay? And you can manipulate it quite easily, shift the curve, and you can see, look, interest rate went down, output went up because investment went up. And therefore, investment went up, people spent that money, they bought a car, and so on. It rippled through the economy through the multiplier. Okay. Okay. You do another one. Let's see if I can keep the colors more or less consistent. Let's do government spending goes up. Those are our two major policy variables. YI, we've got our IS curve, we got our LM curve. This is Y1, this is I1. And then government spending is going to go up. Right? So, always with these things, this is the way theory questions in general, because I know you all got an exam coming up, so you're thinking about questions. This is the way they work for theory questions typically is, well, you know how the Fisher-Gray ones look, because you've seen some of those. But how these ones work is, we got this situation, we're in equilibrium, and then something changes. Trace out what happened and why. Right? And so here we are in equilibrium, and then government spending goes up. Right? And our first job is to say, well, we got two markets here. We got the money market, and we got the goods market. Right? And this graph is bringing those two markets together. So our first job is to say, which market does this affect directly, this government spending going up? Right? Because it's going to affect one of them directly, and the other one it's going to only affect indirectly. When the money supply went up, that affected the money market directly. It affected the goods market in the end through the interest rate and investment and all that, but the direct effect was on the money market, and it was only indirectly through the interest rate that we had the shifts, had the movement along the curve. Right? So if the government spending goes up, it's going to affect the goods market directly, right? Because the government is spending, that's planned aggregate expenditure. It's your C plus I plus G. It's going to shift that. We're going to be buying more stuff at any given interest rate. We'll buy more stuff, and that'll have more output, right? So we know it's the goods market. Goods market is the IS curve, so our IS curve is going to shift. And our next question is which way? Well, the way to think about it is at a particular interest rate, because interest rate's determined in the other market at first glance, creature of the other market. At a particular interest rate, how much output will there be? Well, now the government is spending more, and so there's more people buying stuff. At a particular interest rate, output is going to be higher. Right? You can go through and do the graph, but output is going to be higher. So at a particular interest rate, we are going to have, say, this particular interest rate, we're going to have higher output than before. And that's going to be true for any interest rate, not just the equilibrium interest rate. And so our IS curve, I can make it go through the same line, same dot. IS2, IS1, IS2, the whole IS curve shifts to the right. That is, at any particular interest rate, there's more purchases than before and therefore more output than before. Okay. And so what we get is we have, in the end, output goes up. And in the end, I'm sorry, that doesn't go up to there. It goes up to here. It goes to the equilibrium pit. Y2 goes up to there. And interest rate goes up to there. Bad economist, no biscuit. Okay. However, we can say more about this. Right? We can say government spending went up. Output went up. Now, in our old model, in our old, just our plain old Keynesian model with the cross thing, right? We said we always kept investment constant, which means in that model, output really would have gone up to here. Right? We would have government spending goes up, that's more spending, that makes some people rich, they go out and spend some, they feel rich, they go out and spend some, and through the multiplier, output goes up, and it would go up by that amount that we shifted the curve. Right? Because that curve is drawn, like this original dotted line here is drawn, keeping the interest rate constant, just like we kept investment constant in our original Keynesian model. Right? But now we've brought in the financial markets. And what happens is that this increased spending starts affecting the money market. Right? It's affecting the money market because people are now richer. The government bought some of their stuff and they feel rich. And like rich people everywhere, they go out and buy stuff. And in order to buy stuff, they're going to need some money. And so money demand is going up. Right? And as money demand is going up, the interest rate gets driven up. And we can see that right here. Look, the interest rate's being driven up. Right? So as the interest rate's being driven up, investment is going down. Right? So we've increased government spending, but we're actually decreasing investment at the same time by this increase in the interest rate. Because we're making people richer, and that's all well and good, but rich people want to have some money, and that means there's less money around for other things, and so the price of money goes up, meaning investment becomes more expensive. It's better, not more expensive, well, more expensive if you're borrowing money, but there's better things to do with your wealth than build a factory or go to school. Right? You can loan it out to someone and be rich because the interest rate is higher. So what we get is we get G goes up, which means, let me make two errors. Well, let me sort of trace out the effects just to make it, I don't know if I'll make it clear. I will try to make it clear. Okay, so can we see all this? Sort of, kind of, sort of. Okay, so we get government spending goes up, right? And that makes, naturally, Y will go up. Let me put two arrows here just to suggest that this is large compared to the effects that we're about to see. Okay? Government spending goes up, that makes Y go up. That makes money demand go up. Doesn't matter how many arrows, money demand goes up, which means the interest rate goes up, which means investment goes down, Y doesn't go up as much as it otherwise would be because the interest rate is up. Right? Now this is the whole convoluted chain, and I put like big arrows and small arrows. In particular, the important one is why government spending went up a lot, investment went down a little, and so we still have more output than we had before. There's more spending than there was before, but it's mitigated a bit. And so the big conclusion of this is we get this crowding out effect. By increasing government spending, we can make output go up, but it is at a cost. As we do that, we're driving up the interest rates, and this means we get less investment, right? Which means in the future, we are going to be less productive than we otherwise would be, right? Because investment is anything that makes us more productive in the future. And so we're trading off current consumption against future consumption. Right? So before we put these two together, before we had the ISLM curve, where we just had the goods market, we said you could increase government spending, that'll make output go up. You can increase government spending, that'll make output go up. And of course, we could make it silly and sort of point out the silly assumptions of the model, right, by saying we could do this forever. But even if we're just in the local area, there was no real cost to that. You increase government spending, output goes up. But now, even in the little local area, without really pushing the model and making them have infinite production or anything like that, even if we're like in a recession trying to get out of it, there is a cost now to increasing government spending. Okay? You're going to get more output, but at the cost of future output because interest rate is going up. You get this crowding out of investment. Okay? One way to think about it, where it's often thought about this way in the press, is that suppose we're borrowing money, and this is outside the model, but just to sort of tie this in with things that you'll hear in the press, right? A story that you'll hear in the press is very often government, to spend more, we need to borrow. And that means we're going on the money market, we're going on the market for funds, and we're competing with private investors to borrow that money. And therefore, they don't get the money. If we get it to build a road, that means the private investors don't get it to build a factory, right? Which is a different side to the same coin. But we see it here in the model rather than sort of that loose story. Okay. Anything else I want to say about this? All right. Okay, so taking us through, this is the slides. Every point in the LM curve is an equilibrium point, just an equilibrium point in the money market. Every point on the IS curve is an equilibrium point in the goods market. Right. And it's deriving it, I think. And this is what we said. Playing around with it, this is a decrease in autonomous expenditure. That's like a decrease in government spending, a decrease in like if people become pessimistic about the future, autonomous consumption goes down, shifts the LM curve to the left, interest rates fall, and output falls. An interesting thing here, though, is that just in this model, if, for example, we became pessimistic about the future, right? LM curve would shift to the left because we're buying less stuff at any level of income. And Normally, like in our previous model, output would have fell all this amount up to here. But it falls by less. Why? Because now that people are poorer, they don't need so much money, right? Because they're not buying anything because they're poor. And so as poor people with low income, they're not demanding money, which means that the money demand curve is shifted, and therefore there's not so many people trying to get money. The price of money falls, and investment becomes more attractive. Right? So this crowding out effect works in the other direction as things are getting worse. Right? And so in this case, output doesn't fall as much as it otherwise would. Okay. Now, that's fun to talk about that way, but it's probably not very realistic, because our little story was people become pessimistic about the future, therefore they stop spending. Perfectly reasonable, bound to happen sometimes, right? But probably if people are becoming pessimistic about the future, probably businesses are too. And they're probably less inclined to invest anyway, right? And so when I say people become pessimistic about the future, this probably includes a decrease in investment too, this shift. Now what this does say is that decrease in investment won't be as dramatic as we thought it would be, because they have extra incentives to invest because interest rates have fallen. But thinking of, investment is now going up is probably unrealistic, just because, probably everyone's expectations became pessimistic, not just consumers. Okay, decrease in the money supply is the opposite of what we did. Right? So you decrease the money supply at any particular level of output. At any particular level of output, we have less money, so the price of money is going to go up. Okay? It doesn't go up as much as it otherwise would because we start to feel poor, and as poor people, we don't want as much money. So interest rates don't go up as much as you otherwise would have thought, but they do go up. Okay? And so what we get out of this is first of all a way to think about these two markets together, right? To bring financial markets in. And we get a way to really quickly on the back of an envelope say how these things are going to, the goods and the financial markets are going to interact. How changes in the goods market is going to affect the financial markets, and changes in the financial markets are going to affect the goods market. And we can do it really quick on the back of an envelope. Now, none of it is like a model that you'd really want to press in terms of the assumptions. They're a little bit squirrely. But it keeps giving the right answer, even for like very complicated models. And so, what can you do? It's hard not to draw it on the back of your envelope, because it gives the right answer. We'll have to think a bit more. There's lots of holes in this model. But in fact, it is very good at giving you a back of the envelope. Here's what I think is going to happen. If we increase government spending, we can see the crowding out that's going to happen. We can see that it's going to decrease investment. And this is something that you get out of even very sophisticated models. And you get it so neatly and cleanly here. And again, it is part of the, you sound like you never took an economics class if you don't know ISLM. And so now you'll sound like you took an economics class, and that's lovely. Okay, so next week, we are going to have just review. We have covered everything that we need to cover. I'm going to go over what's going to be on the exam, what topics we've covered. I will answer questions, and I will try, you guys have to help me out. If I start talking, I'm going to run out of things to say, but if you ask questions, I'll be blabbing on all day. So help me out with questions, and that's what we're doing next week.